Welcome to Talk Tickers, where today we're breaking down ConocoPhillips Q4 2025 earnings call. And boy, was it a classic case of the market and management looking at two completely different clocks. The clock that the market was watching, well, that one timed a pretty swift negative reaction. The stock dropped almost 2.5% on announcement day, which is a really clear signal of disappointment with the headline numbers. So this really sets up the central conflict for anyone looking at the stock. You have to ask yourself, is this just a temporary stumble, something driven by short-term noise? Or is this a real buying opportunity based on the very compelling story management is telling about the next few years? Okay, let's dive right into the results that sparked that sell-off. The quarterly print was, to put it simply, a miss. No two ways about it. ConocoPhillips missed on both the top and bottom lines. Their adjusted earnings per share came in at $1.02, and that was a full 8% below what Wall Street was expecting. A miss like that, it definitely gets noticed right away. Now, what's really fascinating here is how management framed the whole situation. They basically laid out this two-clock scenario. Clock number one, that's the quarterly report we just saw, all about weaker prices and missed targets. But they spent most of their time pointing everyone's attention to clock number two. A huge multi-year plan focused on slashing costs and generating massive amounts of cash flow down the road. Let's just stick with that first clock for another minute, the one that investors were trading on today. So what exactly went wrong in the fourth quarter? Well, the main culprit was a big drop in prices. The average price they got for a barrel of oil equivalent fell a whopping 19% compared to last year. See, as a pure-play upstream producer, ConocoPhillips is super sensitive to swings in commodity prices, and that sensitivity was on full display this quarter. But here's the interesting part. Operationally, the company was actually humming along just fine. Production grew by a really healthy 6.3% year over year. So think about that. They were pumping more oil and gas, but they were just getting paid a whole lot less for it. Okay, now let's switch gears and look at the clock management wants us all to focus on. This is their long-term vision, their plan for transforming the company over the next 5 years. It all starts with some serious financial discipline. The CEO, Ryan Lance, was crystal clear. Their main goal for 2026 is to chop a combined $1 billion from their capital spending and their operating costs. And here's the payoff for all that hard work. That cost-cutting, plus some major projects coming online, is all designed to create a massive $7 billion incremental free cash flow inflection by 2029. We're talking about basically doubling their 2025 cash flow. That's a huge number. And hey, this isn't some fuzzy promise for the distant future. Management laid out a pretty clear timeline. They see about $1 billion in gains each year from 2026 to 2028. And then, bam, a huge $4 billion jump in 2029. That's when their massive Willow project up in Alaska is set to start pumping oil. So you might be thinking, that all sounds great, but can they pull it off? Well, to build some confidence in that long-term vision, management gave some key updates to show they're already making moves. First off, they've doubled what they expect to save from the Marathon Oil integration, which is fantastic. They also sold off $3.2 billion in assets last year to streamline their portfolio. And maybe most importantly, their big growth projects, the LNG facilities and the Willow project, are both hitting their key milestones right on schedule. So that brings us to our take. How should we, as investors, think about these two very different clocks ticking at the exact same time? I mean, this is really the fundamental question, isn't it? Do you focus on the weakness right now, which is mostly driven by commodity prices they can't control, or do you bet on management's ability to execute what looks like a very credible, but a very long-term plan? After weighing both sides, we're kicking off our coverage with a market perform rating. And here's why. Look, those headwinds from weaker commodity prices are real, and they could stick around for a bit. And while that long-term free cash flow story is incredibly compelling, there's always a risk when you're talking about projects of this size. So in our view, the current stock price already does a pretty good job of balancing that short-term risk against the long-term potential. Now for our trade idea, which is really a way to play both of these clocks. First, you have to respect that near-term risk. So you could think about selling cash-secured puts with strike prices below $100. This strategy brings in some income right away, while basically setting a lower price you'd be happy to buy the stock at. Then you can take that income, that premium you just collected, and use it to fund a long-dated call spread. This gives you a way to bet on that long-term upside with a clearly defined risk, letting you capture that huge cash flow story if and when the market starts to believe in it too. And finally, we have to close things out with our standard disclaimer. This analysis is for informational purposes only and is not financial advice.